Good afternoon, and welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we want to talk about inflation. Yes, we have been experiencing some inflation since even the beginning of the year. We've started to see prices ratcheting up. Maybe even before that, a lot of us, when we go shopping, we see higher prices. We see higher prices at the gas pump. And in May, the Consumer Price Index, the CPI, came out at 5%. So we know we have inflation right now. The question, however, has been, do we have a temporary situation where we're just seeing inflation that is going to eventually calm down? And we're not really sure about that. And so that's what we want to talk about is what do you do when you see an inflationary environment? And what is the government doing? What are other people doing? What should we do as investors?
Yep. And so the question, as Laura said, is whether is this bout of inflation we're experiencing temporary? Is it a result of the recovery after COVID and perhaps greater demand for gasoline and other commodities, or is it something more fundamental and structural within the economy?
And so one of the things that we always talk about when we think about inflation is it possible that we're injecting too much money into the overall money supply? And there's been a lot of discussions in the economic circles around monetary policy and what is appropriate. We can tell you that the Federal Reserve, as of last week, did make an announcement that they were not going to raise interest rates, which we found a little bit unusual, that they are not really talking about raising interest rates to deal with the inflationary pressures. But even more so, what we see is that the Federal Reserve continues to buy bonds, primarily treasury bonds and mortgage-backed security bonds. And you can see on this chart that this buying frenzy has really started as of the beginning of, 2020.
Yep.
I mean, it's always been there, but they've increased. This is the Federal Reserve balance sheet showing that they're buying more bonds. And the idea around buying bonds is that when the Federal Reserve buys bonds, they're in fact putting cash out into the money stream. And very, very interestingly here, the top line, the blue line, is the total bond purchases, total bonds on their balance sheet. The
Right.
aqua blue is mortgage-backed securities. So they're continuing to buy mortgage-backed securities to help prop up mortgages and consumers to buy housing. And there is some concern around that as well, because we know that that story didn't end well in 2008, although there've been a lot of restrictions put on consumer, the underwriting of mortgages and consumer protection, that we should not see the same type of issues that occurred in 2008 due to that.
Yeah. And there are 3 points here, by the way, and this graph only goes back to around, I guess it goes back to 2016 only. You saw a huge increase in the assets on the books of the Federal Reserve beginning in 2008. They had a quantitative easing policies, which they called it 1, 2, and I think 3. This may be 4 for all I know at this point. And secondly, by the way, there's a famous economist, his name was Milton Friedman, who said that inflation is everywhere and always a monetary phenomena. In effect, it's too many dollars chasing too few goods. Now, some people believe that one of the parameters that would lead to, or at least imply that we would have high inflation, would be the unemployment rate. And there was a famous economic relationship that's called the Phillips curve that said that if employment's really, really low, that would imply that we would have great inflation. But on the other hand, we really didn't have that a year or two ago when we had an unemployment rate around 3.5%. So that curve really hasn't worked well since the 1970s or 1980s, from what I could judge. So there's a new theory that's been promulgated. It's called modern monetary theory, and it has kind of an odd background. It came actually from a trader, believe it or not. Somebody who's a trader came up with this hypothesis that government can spend as much money as it wants, in effect, because it can always print money. Okay. And so this is a summary of the theory, and that's a large government debt does not necessarily lead to the collapse of the finances of a country, as we've been led to believe. Countries like the US can sustain greater deficits without cause for concern. And they, which is really odd, they believe a small deficit or surplus can be extremely harmful and cause a recession. Now, unfortunately, we're going to talk about this further in a minute, but like any economic theory, it's almost impossible to prove these theories either way and to test them.
It's very controversial, for sure.
Yes.
And there has been no empirical evidence that it, in fact, works.
No, and I would say that there are more economists who believe that it's kind of a kooky theory than believe that it actually does make any sense. So here's some of the criticisms of it. First of all, high amounts of debt do lead to high interest costs, usually. We haven't seen that now, but it could lead to high interest costs down the line. As I mentioned, many economists consider it to be a fringe concept. And there have been plenty of times when countries did spend without any limits, and it did lead to inflation in the past. And one important parameter here, and by the way, this leads to one of their justifications for spending and continuing to print money, that, for example, the government can fund universal health care and all these other, what they believe are societal needs without any consequence. But unfortunately, government spending is almost never as efficient as consumer business spending. And when the government spends more, you tend to crowd out business and consumer spending.
And it's important to say, just to be very, very explicit about this, that we, first of all, we know that we need some spending on some infrastructure items and so forth. We're not saying that the government shouldn't spend any money, but there seems to be
and defense.
Yeah, absolutely. A lot of things. However, there seems to be this idea that we can just continue to spend no matter what, and we're never going to see any repercussions. And it's primarily being backed up by this particular theory. And anytime we see that somebody's going to some type of theory based upon an agenda or some emotional component and not actually using mathematical thinking, that makes us nervous, because we know that emotional decisions and decisions that are being driven by agendas are never good decisions.
Yeah, and one of the issues is that, unfortunately, economics is not really a true science from a number of standpoints. For example, I do have a background in science and engineering, and with the true science, you can actually test the effect of one variable on a system, because you can isolate all the other variables and keep them at a constant and not let them vary. So you can actually see how the output of the system changes based on the change in that one variable. Unfortunately, you can't do that with economics. It's very hard to test a lot of the theories. And they try to look at use statistics, and they try to look at other variables and see what effect they have on them. But there's always 30 variables you can't change. And so one of them is the Phillips curve, as I mentioned earlier. It was one of the laws of economics, and it hasn't worked lately. And also, economics and the economy are subject to events that we can never predict. COVID, as for example, a year ago, wars in many cases happen without anybody predicting that they're going to occur. And also economics, because it's not a true science, is another area of call it social studies, whatever you want to call it. It's highly politicized.
Social science.
Yeah, it's a social science. Thank you. It's highly politicized. And so a lot of people can sort of bend some of its rules that kind of fit, as Laura said, well, a few minutes ago, sort of their goals and what they want to happen.
So Steve, I just want to say something about that, because I happen to love economics.
I do too. I actually do
really
too.
It's the precursor to the financial concepts and principles that we use. So we can't completely discount it.
Nope.
And so how do we necessarily think that one theory is more important than another? For example, modern portfolio theory, which we're so such big proponents to it. When we start seeing the applications of these theories over and over again in empirical literature, and we start seeing how it has evidence of really working, we tend to gravitate towards it, even though it hasn't been proven beyond a shadow of a doubt. And part of the problem with all of these different theories is that there are a lot of latent variables that are undetected and that you have to consider. And it's the reason why we can't always predict with absolute certainty that a model is going to work. We can only say it's directional. We're using some thought process in our choices as opposed to just, arbitrarily making choices. So, we can't completely throw it out. And this is why we have to use our noggin when we make these choices.
And by the way, one thing we're always working here with economics is that one great unknown, and that's human behavior and effect of different conditions on human behavior. And that's something you really can't quantify in an ecoation within economics,
Absolutely.
quite honestly. So it's a big issue.
Right. So, our conversation really started out by saying that we have these potential inflationary issues. We talked a little bit about what the Federal Reserve is currently doing regarding inflation, and they're kind of sitting back saying, well, yeah, maybe we're seeing some inflationary pressures, but we're really not sure if it's going to last. We think that it's transitory, and so we're not really going to do much about it. And there's the whole argument about this being transitory. And so the question is, do we anticipate some inflation? And we do think that this is something as investors that we can't just ignore, that we have to pay attention. And so we start looking for different types of investments, different types of assets that do well in an inflationary market. And one of the very, very clear asset classes is the natural resource / commodities asset class.
Mm-hmm.
And so here we're showing you a Bloomberg slide that shows you the relationship between inflation and natural resources.
Yep. And by the way, we've always held natural resources in our portfolios, at least as long as it became readily available as an investable asset class. And by the way, in this graph, I think blue is a CPI, by the way, the blue graph, the Consumer Price Index. And in white is our natural resources here. It's a natural resources index. And so you can see that it's starting to trend up after trending down for, many years here, right? The natural resources index. It's not shooting up quite as fast as the CPI, because the CPI is only reported monthly, but you see that the trend is beginning to match the CPI. And the natural resources index is beginning to experience price increases.
And Steve was talking about this whole issue about behavioral finance and people making. So one of the things that we know is that with the idea of recency bias, a lot of people don't really, when they look in the rear view mirror and see the past couple of years, they don't see inflation as a problem. They also don't see the value of even holding natural resources, because over the past couple of years, they haven't done that well. But however, we have seen natural resources really keep portfolios together over any 20-year period of looking at data. And that's why we insist on holding it.
Yeah.
This slide is where we're showing actually the more some detail of specific natural resources. And when we talk about natural resources, we're usually talking about precious and base metals. We're talking about agriculture, and we're talking about energy.
Energy products.
This is being represented here. The copper, the gasoline, the lumber. We don't have gold on here, but that's another clear natural resource that would be included.
Yeah, these were chosen purposely because there are actual inputs into production. Gold really isn't as much. It's not as used as much in industry. But of course, lumber is used by construct houses and buildings and other uses. Copper, of course, we know how important copper is to an economy. It's really based so much on electronics as it is today. And gasoline, which is energy, is really an input into every product for the most part, as is energy in general. It's in the creation of many products. Gasoline, not necessarily gasoline, but other oil products are used to create plastics. Actually, natural gas is used to help create fertilizer for farms, believe it or not. And also gasoline in particular is used to deliver the products to the market. So if gasoline goes up in price like it has so dramatically, I think it's up about $1 a gallon from what I've seen about a year ago. That trickles through the cost of every product that you purchase as a consumer.
So as Steve said, these have real purposes, but they also are tangible assets, which is different than stocks. So you know that they're a little bit of a different type of animal than what you invest in when you invest in the stock market. And in terms of what they represent, these assets don't go bankrupt.
No,
We're a company that go bankrupt. So
Hmm.
there are, when we're looking at asset classes and how we fill out your portfolio, we're looking at each asset class for what is their source of risk. And if their source of risk is different than the US stock market, it clearly is going to be a diversifier.
Mhm. That's exactly correct. And by the way, to get back to the performance of natural resources, it had probably 4 or 5 really poor years. I'm going to say from 2014 to 2020. And I think a lot of firms moved out of natural resources because of that. We don't generally like to make those types of decisions because we know at some point it's going to recover. And guess what? It's up about 30% this year.
Right. And
Yeah.
Steve, people are just starting to talk about maybe we should put natural resources in our portfolio.
We always had it.
They just missed the 30% run up.
That's a good point.
With trying to time when you're going to get in something or when you're going to get out is that you usually miss the largest bump.
Yep, that's correct. And what's interesting now is we've been rebalancing a number of our clients in the last couple of weeks, maybe the last month or so. And in many cases, our rebalancing, because of our rebalancing approach, a lot of our clients, their allocation toward natural resources has now exceeded the threshold. So we're actually taking some profits off and paring it back a bit. So you've already seen some benefit from that 30% runoff. And so right here in this slide, by the way, we show here a comparison of return since 2016 of a couple of actually two natural resource funds and a couple of natural resource indices. The one on the top line, that PDBC, is the holding that we have in a natural resource category. It's an ETF, an exchange traded fund. The second one down is one that we used to use. We haven't used it in 3 or 4 years. It's actually a PIMCO mutual fund. And the last 2 lines are commodities indices. The first one's a Bloomberg Commodities Index, which I would say is one that's better used to model a PIMCO fund. And the one on the bottom is a Deutsche Bank Commodities Index, which more closely matches the ETF that we use for our commodities holdings in our clients' portfolios. And you can see now this was through June 17th. And the total return for our index was about 22% over that time period, or about 5% a year roughly now. And as you can see here, up until the beginning of 2020, if you look at the graph, you can see the return for our most commodities, both the indices and a couple of funds we list here, was negative. But now look at everything's positive now, merely because of what happened since, I would say, the first quarter of 2020. If you actually go back to that quarter, commodities are up about 50%, believe it or not. And so now the 5-year annualized return for commodities in our holdings is over 5%. So.
And there are a lot of ways that you can get exposure to commodities. One is an ETF, one is an actual mutual fund, which is being managed. Another is even based upon using a lot of futures. We think that there's some problems with the other choices than what we're using right now. Our ETF, for example, because it's not required to pay out dividends and pay out income to shareholders, is a very tax efficient way of exposing you to commodities. The PIMCO one, however, is not so efficient. Most of its growth, most of the commodities growth has been in creating income. So they've been paying that out and creating tax events in people's portfolios. So although you may not realize that we're saving you money on the tax side. As comprehensive financial planners, we feel very strongly that we can't just focus on the investing piece. We need to worry about your taxes as well. And so that's why we think that this specific ETF is better than the PIMCOs.
Yeah, and I just want to mention why that is, because mutual funds have a requirement under the 1940 securities or whatever the rest of the act is called, that they have to pay out, I think, 95 or 98% of their income to shareholders each year, whereas ETFs do not actually have to do that. And so a lot of the return you realize in an ETF is through a price appreciation and not through distributions.
Yeah, and so here you can see the relationship. If you just look at the red line with the S&P 500, the relationship of commodities to the S&P 500, as each of these different funds are related to the S&P 500. And you can see our ETF is actually the least correlated with a 0.56, which.
Yep. And so with a correlation table, if something's completely correlated with something else, it provides no diversification value. But when you have something that's only maybe half correlated with something else, it provides a lot of diversification value. And also, by the way, it really provides excellent opportunities to improve your return through rebalancing. And also volatility also works in your favor if we rebalance on a routine basis. And I just want to mention, we included one other fund in this correlation table, this BlackRock commodity strategy, which we're not going to get into a lot of detail here today, but we looked at that fund, but then when we looked under the hood, we realized it was not a pure commodities fund. They also invest in stock, and we didn't want that. We want pure commodities exposure. And you can see the rationale here because of the relatively low correlation of commodities with the S&P.
This is actually, that correlation for that BlackRock is actually lower than what I expected, because when we talked about style drift a couple of other videos ago, we talked about the fact that when we actually looked at the Bloomberg terminal and tried to understand what the components were of the individual funds, we saw that BlackRock had a lot of S&P 500 actually embedded in it. Yes. And this goes, I mean, it says
about 30%. It was about 30%, in fact.
Yeah, and we see that the title of the fund, you think you're investing in commodities, but yet you're not actually investing in it completely when you look under the hood.
Now, I will say to their credit, they state that if you read the fund description, but someone who's not really that knowledgeable about investing maybe could be fooled by that name.
Yeah, Steve, does everybody read the prospectus?
No, and yeah, you're right about that. You know.
Yeah. And this is what actually the components of the holding that we are using right now. Yep. And you can see it has, again, you know, all of those components: the energy, the base metals, the agriculture, and even the precious metals. So for those of you that have called up recently and said, hey, should I own some gold? You already
own it. Besides your ring, you own it.
Yeah, but a little. You can't hold a lot of this asset class because it's very volatile. I mean, there's opportunities to have tremendous growth at the right time, but it can be very volatile. And so it needs to be a hedge against the market, against inflation, and not as your whole portfolio.
No, definitely not. Yep. It's a very good point, Laura.
So, in conclusion, we think that we're not sure what's going to happen with inflation. Perhaps it is transitory. Perhaps it's all going to work itself out. Although we do think that there are some elements that give us pause and make us think that maybe we might see a little bit more inflation going forward than we have in the most recent years. But regardless, we still think that as investors, we need to pay attention and we need to make sure that we hold asset classes in our portfolios that are do well in different kinds of economic environments. The whole idea of having an all-weather strategy is really important to us. And so we have other asset classes that also will support us in a more inflationary environment. And perhaps we'll talk about that next time.
Yeah, I just want to mention that would be REITs as for one. So
Yep. Which have done phenomenal.
they're up over 20% for the year roughly as of a couple of days ago.
Right. So thank you for listening to us, and please give us a call. Send us an email if you have any suggestions or thoughts about what you'd like to hear from us.
Yep.
Bye.